Namaskar and welcome back. Today we are going to discuss covered put right strategy. This strategy is a combination of two positions. One is the investor goes short on the underlying asset and he takes the short put position. So let us discuss this strategy in detail. This strategy is generally taken over by those investors who have a neutral view about the market in the near future, or they feel that the market will either be neutral or it will be range bound or it will go slightly downwards. That is it will be bearish in nature, right? So it involves two things. One is that the investor has a short position on the stock, right? So basically he is shorting the shares. Now we know that the payoff of a short position is like this, right? So if the prices moves down, you will be squaring off your position by buying the shares at the spot price. So this is the profit, right? But then if the prices moves upwards, you will be subjected to unlimited loss, right? So what do you do is that the investor feels that the market will be neutral, that is it will be here only or it will slightly move down, right? So what he does is he wants to enjoy the amount of premium, right? So he covers this position, he clubs this position by selling a put option, right? So let us take an example that there is a writer of put option at an exercise price of rupees 50 for ABC stock. ABC is the underlying asset, right? So what he does is he clubs this position along with a short position on ABC stock, right? So now let us see what happens if the market price is equal to rupees 50, it is greater than rupees 50 or it is less than rupees 50. If the price in the market is less than rupees 50, so let us assume that if the price is say rupees 45, right? If price is rupees 45, now on short position, you have taken the short position at a price of rupees 50. You will have to square it off by buying it at a price of rupees 45, right? So you are selling at 50, buying at 45, there is a net profit of rupees 5, right? This is your profit, right? Now on short put position, what will happen? The holder will come to you and say, I want to exercise the option. Why? Because the spot price is less than your exercise price. So what will happen is that you will have to oblige the holder of the option and you will be having a loss on your short put position. The loss would be 5 rupees. This is your loss. Okay, I put bracket over here also. Fine. So you'll have a loss of rupees 5. Fine. Now on short put position only, you have received a premium. How much premium did we receive? Rupees 3. So your net payoff because of this entire thing is plus 5 minus 5 plus 3. So your net payoff is 3. That is equal to the amount of premium, right? Now if the price is more than rupees 50, let us assume it is rupees 66 or 56. 56, let it be 56, right? So now what happens is on short stock we took at price of rupees 50. You are covering it, you are closing this position by buying it at a price of rupees 56. So you are selling 50, buying at 56, so a loss of rupees 6, right? On short put position, the option goes unexercised. Why? Because the spot price is greater than your exercise price and this is not exercised by the holder now and you enjoy the amount of premium. So that amount of premium is 3. Fine. So now what happens is that if you would have not taken the short put position, you would have suffered a loss of rupees 6 on your short stock position. So you are able to reduce this loss by the amount of premium. So now your net loss is equal to minus 3, right? Similarly, if the price is equal to rupees 50, then 50, you have taken a sell position, you square it off at a price of rupees 50, your net loss is nil, right? At a price of rupees 50, if we assume that the holder comes to exercise the contract or he does not exercise the contract, then also you are enjoying a premium of rupees 3. So your net payoff will be 3, that is amount of profit. Fine. So this is how the covered put right works, and this is the payoff table for a covered put right. So this second column represents your short put payoff, which we discussed earlier. This third column represents your payoff on the short position, and this is the combined payoff for a covered put right. Fine. So covered put right is basically, see, uh, covered put right is this yellow line which is being represented over here, and this purple line is your short position. You are clubbing this position with a short put position. Fine. Now the break even point occurs at what? At this point, and this is your futures price, that is 50 rupees plus the amount of premium. Fine. Now why do we take this strategy? Investor is interested in this strategy because he feels that the prices will remain somewhere over here, that is around 50 and somewhere here, right? So he wants to enjoy the amount of premium from the short put position. Also, that if he clubs the short position with a short put position, he is able to move his break even point from this point to this point. That is, it will take more, it will have to be on the higher side, right? So he is able to safeguard himself up to a certain extent, right? But the disadvantages of this strategy is that if you look here, the investor caps his profit because of this position. If this position would have not been there, short put, then he would have earned this amount of profit, right? So by entering or by clubbing these two positions, you are limiting your profit up to the amount of premium, right? And another thing is that if prices go beyond your expectations, they increases, right? Then you are able to reduce your loss only up to the amount of premium, right? So this is the protection which your short put is providing to the to your short stock position, right?